Higher interest rates has a positive effect and potentially a negative effect. It drives the borrowing costs up for customers, much more on the corporate side than it does on the retail side, because retail mortgages, for example, are fixed rate, so the rates don't change. On the deposit side of the balance sheet, we benefit from higher interest rates. It's the nature of our book. In terms of the impact so far, anyway, on credit conditions, NPLs, non-performing loans, we really haven't seen a trend emerge yet. But I think it's fair to say, looking forward, the risks are higher because interest rates are now at 6% or thereabouts, which is a lot higher than 12 months ago. So what we've done ourselves is we've modelled some of the risks and we've taken some provisions, expecting perhaps a higher level of NPL in 2024. Not dramatic, and we still think.
What's the percentage?
Well, we've guided a cost of risk to analysts between 30 and 60 basis points or thereabouts, and it could drift towards the higher end of that range, which is still, from an industry point of view, conservative. So you'd expect credit conditions to get a bit tighter next year, globally, not just in Saudi Arabia.
Where does SAB's working capital stand? And here we're talking liquidity.
From a capital point of view, our Tier 1 is obviously well above regulatory hurdles and in a strong position. In liquidity, we are one of the most liquid banks in the kingdom. We will tap capital markets when and if required, but our deposit growth has been strong, as well as our lending growth. So at the moment, and if you look at the industry overall, the average weighted loan-to-deposit ratio for the banks is somewhere around 80, which is well within tolerance levels. So there is this capacity to keep funding growth in the market.
And do you easily transfer the higher rates to your customers?
So as I said, the corporate market is mainly a floating rate market, and so loans reset on average between 3 and 6 months. So corporates do feel the higher costs of rates. But retail investors, because most of the mortgage market is fixed, won't see higher rates. Of course, new mortgage customers will see higher rates, but existing mortgage customers won't tend to see that.